Welcome. What is a backstop and how does it affect the banking system? In finance, a backstop refers to a financial arrangement or commitment that is made in order to provide a safety net or support for a particular transaction or investment. It is essentially a guarantee or insurance policy that ensures that a deal or investment will go through as planned, even if unexpected circumstances arise. For example, a backstop might be put in place to ensure that a company can successfully complete a public offering of stock. In this case, the backstop might involve a commitment from an investment bank or other financial institution to purchase any remaining shares of the stock if there is not enough demand from other investors. This would help to ensure that the company is able to raise the necessary capital it needs to achieve its goals. Backstops can take many forms and can be used in a variety of different financial situations, including mergers and acquisitions, bond issuances, and other types of capital-raising efforts. Ultimately, the purpose of a backstop is to provide reassurance to all parties involved in a financial transaction that there is a fallback option in place in case things don't go as planned. How would that affect the banking system? The use of backstops in the financial system can have both positive and negative effects on the banking system. On the positive side, backstops can help to reduce the risk of financial instability by providing a safety net for financial institutions and investors. For example, during times of market stress or economic downturns, backstops can provide a source of liquidity or capital that can help to prevent bank failures and other forms of financial distress. This can help to stabilize the financial system and prevent broader economic damage. However, there are also potential negative effects associated with the use of backstops in the banking system. One concern is that the existence of backstops can create moral hazard, meaning that banks may be more inclined to take on risky investments or engage in other forms of reckless behavior because they know they have a safety net in place. This can ultimately lead to greater financial instability and increase the risk of bank failures and other forms of systemic risk. Another concern is that the use of backstops can lead to a concentration of risk in the financial system, as financial institutions may be more likely to invest in the same types of assets or engage in similar types of activities knowing that there is a safety net in place. This can make the financial system more vulnerable to shocks and increase the risk of contagion during times of market stress. Overall, the use of backstops in the banking system can be a double-edged sword, providing important benefits in terms of financial stability but also posing potential risks and challenges that need to be carefully managed. What else should I know? Here are a few additional points to keep in mind about backstops in finance. Backstops can be explicit or implicit. Explicit backstops involve a formal agreement or commitment to provide support in a particular situation, while implicit backstops may be more informal and based on expectations or assumptions about the behavior of market participants or government regulators. Backstops are often put in place to address market failures or other inefficiencies in the financial system. For example, if there is a lack of demand for a particular type of asset, a backstop might be put in place to help ensure that the asset can still be sold and that market participants can still access the capital they need. The use of backstops can be controversial, particularly when they involve government intervention in the financial system. Some argue that government backstops can distort market incentives and lead to moral hazard, while others argue that they are necessary to prevent broader economic damage and promote financial stability. Backstops can take many different forms, including guarantees, insurance policies, credit lines, and other financial arrangements. The specific form of the backstop will depend on the particular situation and the needs of the parties involved. Finally, it's worth noting that the use of backstops is not limited to the financial sector. Backstops can also be used in other areas of the economy, such as in trade negotiations or other forms of economic policy. In these cases, backstops may be put in place to provide a safety net or ensure that certain outcomes are achieved in the face of uncertainty or unexpected events. What happens when a central bank has to sell government debt at a loss because of a collapse and a lot of people wanted their money in a 48-hour time span? If a central bank has to sell government debt at a loss because of a collapse in the market, this could have several implications. Firstly, the central bank could suffer a loss on its investment. If the central bank had purchased the government debt at a higher price and is now forced to sell it at a lower price, it would realize a loss on the investment. This could reduce the central bank's profits and could potentially affect its ability to meet its operational and financial obligations. Secondly, selling government debt at a loss could have broader implications for the market. If the central bank is a large holder of government debt, its sale of that debt could potentially flood the market and drive down prices further. This could lead to a contagion effect, where other investors start selling their holdings of government debt as well, which could exacerbate the collapse. If a large number of people are trying to withdraw their money from the banking system in a 48-hour time span, this could create a run on the banks. A run on the banks occurs when a large number of depositors withdraw their funds simultaneously, putting pressure on the banks to meet the demand for cash. If the banks are unable to meet the demand for cash, this could lead to a systemic crisis and potentially trigger a broader financial collapse. To prevent this from happening, central banks may need to step in and provide liquidity to the banking system. This could involve injecting funds into the system through various means, such as open market operations or providing emergency loans to banks. The central bank could also take other measures, such as imposing restrictions on withdrawals or implementing capital controls, to try to manage the crisis and prevent it from spreading further. What else do I need to know? Here are a few additional points to consider. When a central bank buys government debt, it is effectively injecting money into the economy. This can stimulate economic activity and help to boost growth, as the government can use the funds to finance public projects or to pay down other debts. Conversely, when a central bank sells government debt, it is effectively removing money from the economy. This can have a contractionary effect and can potentially slow economic growth. In some cases, central banks may purchase government debt as part of their monetary policy tools. For example, during times of low inflation or economic recession, central banks may engage in quantitative easing, (K), which involves buying large amounts of government debt in order to increase the money supply and stimulate economic activity. If a central bank is forced to sell government debt at a loss, it could potentially damage its credibility and reputation. This could make it more difficult for the central bank to effectively manage the economy and implement monetary policy in the future. A run on the banks can be very damaging for the financial system and the broader economy. To prevent runs from occurring, central banks and other regulators often implement measures to ensure that banks have adequate reserves and liquidity to meet depositors' demands for cash. In some cases, government intervention may be necessary to prevent a systemic crisis from occurring. This could involve a variety of measures, such as bailouts, guarantees, or other forms of support for the banking system. However, such interventions can be controversial, as they may be seen as rewarding bad behavior or bailing out investors who took excessive risks. Like, comment, subscribe, to follow along for the trip.